Let us start with our first theory question. November 2009 IPCC question number 8IIB. So friends, the question is explain the following terms. In that the question says that you are required to explain desirability factor, and we understand that the desirability factor is mainly useful for the purpose of, that is, say desirability factor is nothing else but it is a profitability index. What we can write in the desirability factor or profitability index? The first thing that say we can write that what is the meaning of PI or desirability factor. PI is indicating what is the present value of the cash inflow for every 1 rupee of the investment that you make in the business. It is indicating the present value of the cash inflow for every 1 rupee of the investment that you make in the business. If it is 1.50, it means that for every 1 rupee that you invest in the business, you get in the present value term 1 rupee 50 paise. That is what the meaning that it has. Higher the profitability index is indicating that the project is going to generate more in the present value term for every 1 rupee of the investment and vice versa. Second, you can always write that say what is the decision making criteria. We can say that when PI is exceeding 1, then in that case the project is worth accepting and vice versa. Third, we can write a specialty about the profitability index criteria when there is a situation of capital rationing plus the projects are of divisible in nature. Then in that case ranking of the projects based on the PI criteria would be the best. That is what we can mention. And lastly we can write the formula. These are the 4 things that say you can always mention with respect to the PI criteria. So let us read the answer. In certain cases, we have to compare a number of proposals, each having different amount of the cash inflows. One of the method of comparing such proposal is to work out what is known as the desirability factor or profitability index. In general terms, a project is acceptable if PI is greater than 1. Mathematically, its formula is like this. This is what they have mentioned. Again, IPCC, November 2011, question number 5IB. Next question is, you are required to distinguish, you are required to give the difference between the NPV criteria and IRR criteria. That is a question. Let us see that say, what is the difference between both of them? We can have the difference between both of them like this, that NPV is calculated in amount term, while IRR is calculated in percentage term. Based on NPV criteria, the project is worth accepting if the NPV is positive. Based on IRR criteria, the project is worth accepting if at all the IRR is greater than cost of capital. Next, we understand that the NPV criteria assumes that the internal cash accruals can be reinvested at the company's cost of capital, while over here the assumption is made that the reinvestment of the internal cash accruals at the IRR rate. Over here there is a situation of multiple IRR, means more than one discounting rate at which the NPV of the project would be 0. Over here we don't have the multiple NPV concept. It is at one discounting rate we will have one NPV only. These are certain differences that we have. So the first point that they have mentioned is results of the NPV and IRR regarding the choice of an asset under certain circumstances mutually contradictory under 2 methods. We know that there are 3 circumstances in which they will contradict. First is that the initial investment differs. Second is the pattern of the cash flow series is different. Third is the lives of the project are different and the projects are of one-time acceptance. The terms of the NPV expressed in the financial values, that is in the rupees term, while IRR is expressed in the percentage term. Third, in NPV, cash flows are assumed to be reinvested at the cost of capital, whereas in IRR, the reinvestment is assumed to be the IRR rate. And this is the most important difference according to me. Under IRR method, a project is selected when IRR is greater than the cutoff rate, whereas under NPV method, the project is acceptable when the NPV is positive. So the decision making criteria is specified by them. Next, IPCC November 14, question number 7C. Next question, question number 7C. What is IRR? That is a question. So we are required to give the explanation of the IRR. Okay. So again, we understand that say, first is we can explain and say, what does the IRR mean? IRR means the rate at which the NPV of the project is 0. It is indicating that, so this is the maximum cost that you can afford for the project, because this is the rate at which we are getting the return. Second, we can say something like this: IRR is calculated using trial and error method. It means that say we compute the two discounting rates. At one of them, the NPV would be positive, and at another it would be negative, and then both of them are supposed to be interpolated. Third, IRR criteria makes an assumption that the internal cash accruals can be reinvested at IRR rate. Fourth, in case of exceptional cash flow series wherein there is a change in the sign of the cash flows, we will have the multiple IRR situation. Fifth, we understand that say, based on IRR criteria, the project is worth accepting if the IRR is greater than the cost of capital, not otherwise. These are the things that we can always mention. Friends, over here, my suggestion to all of you is to mark out a few points like this beside this answer. During your examination, you may not write exactly the things that they have provided in the suggested answer, and say we can have the writing of the answer in our own method. That is also acceptable. Next, so it means so we are reading the answer of the institute. It is the rate at which discounted cash inflows are equal to the discounted cash outflows. Means NPV 0. It can be stated in form of a ratio as under: present value of the cash inflow divided by present value of the cash outflow is 1, means NPV is 0. This rate is found by trial and error method. This rate is used in evaluation of the investment proposals. In this method, the discounting rate is not known, but the cash outflows and cash inflows are known. In evaluating investment proposals, IRR is compared with the required rate of return, known as the cutoff rate. If it is more than the cutoff rate, the project is treated as acceptable, otherwise the project would be rejected. That is what we understand. Next question, November 2015, question number 5C. The next question is distinguish between the NPV and IRR for evaluating the projects. Dear students, it has already been covered earlier. Next question, November 17, question number 5D. So the next question is, which method of comparing a number of investment proposal is most suited if each proposal involves a different amount of the cash inflow? Explain and state its limitation. Answer of the question: the profitability index criteria is best suited if each investment proposal involves different amount of the cash inflows. PI considers both present value of the cash inflow and present value of the cash outflow. Mathematically, desirability factor, benefit cost ratio or PI is calculated as under: it is simple present value of the cash inflow upon investment. PI is known as a superior method of comparing number of investment proposals than NPV. However, there are certain limitations of the PI criteria. PI fails to guide in resolving the capital rationing when the projects are indivisible. So dear friends, in case of the indivisible projects, we have to go with the combination of the projects criteria. Even in that case, the PI criteria will fail to give the best ranking. Once single large project with high NPV is selected, possibility of accepting several small projects which together may have higher NPV than the single project is excluded. Dear students, this point is provided by them over here as a limitation of the PI, but actually this is the limitation of the NPV criteria. I explain this point that they have provided as a limitation of the NPV criteria. Suppose we are having, say, the funds of 10 lakhs, and let us say that there are 4 projects which are under consideration. The investment proposal is 2 lakhs, 3 lakhs, 5 lakhs and 10 lakhs. NPV is 1 lakh, 2 lakh, 3 lakh and 4 lakhs. Now if at all you are ranking the projects based on the NPV criteria, then definitely we understand project D for Delhi will be accepted first. And if at all you accept D for Delhi project, then in that case, of course, what will happen? We understand that say you end up with the NPV of only 4 lakhs. But instead of that, if at all you would have accepted project A to C, then in total NPV would be an amount of 6 lakhs. So this is what's the limitation that say they have provided of NPV criteria under this heading. I am reading this again. Once a single large project, that is project D in our example, with high NPV is selected, possibility of accepting several small projects A, B, C, which together may have higher NPV, then the single project is excluded. Also, situations may arise where a project with the lower PI selected may generate the cash inflow in such a way that another project can be taken up 1 or 2 years later, the total NPV in such a case being more than one project with a higher PI. So friends, over here the C point is provided to us like this. What happens at say year 0, year 1, year 2, year 3, year 4, year 5. Project A, B, C, D. Outflow, again outflow, again outflow. Suppose something like this is there. Now it may happen that the profitability of, that is PI, of D for Delhi is greater than profitability index of B. So based on the PI criteria, if at all you do the selection, then in that case, of course, you will select the D for Delhi instead of B for Bombay. Now it may happen like this, that since you did not accept the project B for Bombay, you cannot accept even A for Ahmedabad. Why? Because later on whatever the cash flows which are required over here, that project B could have financed, but D cannot finance. There may be a situation like this. So going with the decision making through the PI criteria will have this limitation. So basically when we have the limitation of the cash flows in more than 1 year like this, then in that case there is a technique in the operational research which is given a name as linear programming. So we have to apply the linear programming technique over here for decision making. Next, May 18, in that 7D, the question is explain sale and lease back. Now, understanding this sale and lease back proposal, for that I give a small example to you like this. Let us say that there is a company which has a large building and it has a huge factory building. Now this company is having basically like a situation wherein it is in a crisis and this company requires funds in order to carry on the business. Management of the company is very optimistic that whatever the crisis situation that we have is only for some time period, and over this next 3 years or over this next 5 years we will be able to recover from the situation. Now basically this company is like, if at all it is going for the funds raising in the market, then in that case it is not able to raise the funds. Why? Because they have lost trust of investors. The recent financial position, that is the recent finances, that is the financial statements of the company, are not so lucrative that anybody would finance it. So what this company is considering, that we will sell this entire fixed asset to somebody and we will acquire the same on the lease back. So what happens that you sell the entire factory building and you lease it back from the finance company, because usually this will be done by the finance company. So basically for the purpose of carrying on the business you require this fixed asset. So what will happen, that you will sell it, but at the same time you require it for the purpose of carrying on the business, so you acquire it back on the lease, and this is technically given a name as sale and lease back. This is what we understand. So keeping this concept in the mind, let us read what they have specified. Under this type of lease, owner of an asset sells the asset to a party, buyer, mostly it is a finance company, friends, who in turn lease back the same asset to the owner in consideration of lease rental. Under this arrangement, the asset is not physically exchanged, but it all happens on the records only. Because you will be occupying the same building, you will be occupying the same asset as lessee instead of owner. The main advantage of this method is that the lessee can satisfy himself completely regarding the quality of an asset, and after the possession of the asset, convert the sale into a lease agreement. And friends, mostly this kind of agreements will have an additional point that once the lease period is over, let us say after 20 years or maybe after 15 years or whatever may be the time period, the lessee will have a right to purchase the asset from the lessor. Maybe the price will also be decided at the time the agreement is entered upon. Next question, November 19, question number 6B of CA Intermediate. The question is, explain the steps while using the equivalent annual criteria, equalized annual criteria. So over here, equalized annual criteria, the method involves following steps. Compute NPV using the weighted average cost of capital or the discounting rate, means normal cost of capital. Compute the present value of the annuity factor of discounting factor used above for the period of the project, maybe the 5 years, 4 years, or maybe any other time period. Divide NPV computed. This is the way we are required to make the computation of the equalized annual NPV. We understand that so mostly this kind of NPV is calculated whenever the two projects which are of mutually exclusive in nature have the different time period. Then in that case we apply this kind of criteria for the purpose of decision making. You can see friends that so this is the 3 marks question and this is the answer of the ICAI publication. I have not worked any hard for providing these things to you. It is only the answer of the institute publication that itself is what I have provided to you. Nothing more than that, friends. And with this you will be given full marks. Remember that so there is no standard deduction. You will be given full marks in this case. Next question, CA Intermediate, January 2021, question number 6C. And the question is say definition of the IRR. That also we have recently understood in detail